We've seen that equity is a source of funding, a source of capital for a business, for operations. It's also an investment by investors, shareholdings. Debt is also a source of capital, and it's also a form of investment. So if we make a loan, say we lend 40 to this company, we're going to expect, require, write up contracts for repayment of the money we lend and interest on top and some security, generally speaking, to deal with the situation that we don't get the capital and the interest repaid as per the contract. So debt is a form of investment. It can be a loan. It can be a bond, which is essentially a formal document which is evidencing a loan. An example of a bond is gilt-edged stock issued by the government. It's a very safe form of debt investment, is lending money to the government in the form of gilts. So the government can have a balance sheet, and in there is debt. If we own the debt owed by the government or by anybody else, we've got an investment. We're expecting repayment in full in accordance with the terms of the loan, the bond, the lending, and we'd expect some interest return on top. So both debt and equity can be investments. That's the investor perspective. From the one who's using the capital, then there's sources of capital, sources of funding. And if we're going to keep the investors happy, to keep their money invested in the business, we need to provide them with a flow of information.